Hello and welcome to Swag Academy. In this video, I will make an in-depth stock fundamental analysis of the company British American Tobacco. I will cover its history, business model, growth, balance sheet, profitability, valuation, dividends, and finally do the 3M analysis. British American Tobacco was founded in 1902. Its current CEO is Tadeu Marroco. I hope I pronounced it right. Its headquarters is in London, England. The company has a $66 billion market cap. Its stock is trading around $29 at the time I'm making this video. The company manufactures and sells cigarettes, tobacco and other nicotine products. It is one of the largest tobacco companies in the world based on net sales. BAT has operations in around 180 countries, and its cigarettes brands include Dunhill, Kent, Lucky Strike, Pall Mall and others. British American Tobacco is internationally active, while most revenue comes from the USA. They also have a big market in Europe, Asia Pacific and Middle East, as well as in Americas and Sub-Saharan Africa. 81% of BAT revenue comes from combustible cigarettes, the rest from traditional oral and new categories. They include vapor products or battery-powered products and heated products. British American Tobacco is not alone in the tobacco industry. It is facing competition from imperial brands, Philip Morris, Japan Tobacco and others. This map shows the company with the highest market share of cigarettes by retail volume in 90 countries. Pause the video and check which brand is dominant on the map. BAT grew its revenue from 21.8 billion in 2014 to 34.5 billion in 2023. Considering that the price of cigarettes have been increasing in most countries, it has more than doubled the last 10 years. This means the selling volume of cigarettes sold have been decreasing. As you can see in this graph, the number of smokers all over the world is decreasing every year, meaning the revenue of British American Tobacco will stay the same or decrease in the coming years. Now let's check the profitability of the company. The gross profit is the result of revenue minus the direct cost to create these revenues. The gross profit margin is the result of gross profit divided by the revenue. The gross profit margin shows the amount of profit made before deducting selling, general and administrative costs. The gray line in the chart represents the gross profit margin over the years as a percentage of revenue. The gross profit is around 83%, which is very high comparing to other companies and industries. However, this is reasonable since it does not cost so much to produce cigarettes. Now let's check the operating profit and the operating profit margin. Operating profit is the net income derived from a company's core operations. It is the amount of money that a company has left over after meeting its operating costs, but before paying its taxes. As you can see, BAT is profitable. The year 2023 is an exception. The company made around 14 billion operating profit in 2021 and 2022, which is very good. Now let's check the free cash flow. The free cash flow represents the cash a company can generate after accounting for capital expenditures needed to maintain or maximize its assets base. It is the cash that is left for investors and owners of the company. BAT free cash flow was between 12 and 13 billion dollars since 2020. This is a cash flow yield of 37%, which means from every dollar revenue the company makes 37 cents are left for investors. A very profitable business. Now let's have a quick look at BAT's balance sheet. BAT has around 9 billion pounds in current assets excluding inventory. The current assets are the assets that are liquid and available to the company within 1 year. They include cash and short-term investments. BAT total current liabilities, which are the liabilities the company must pay within 1 year, are 15.67 billion pounds. BAT total liabilities, including long-term debt, are 50.1 billion pounds. So the company have a ton of debt, as you can see. BAT free cash flow is $13 billion. The debt to free cash flow ratio is around 4, which is relatively high, meaning it will take the company 4 years to pay the debt assuming they stop paying dividends, which is something I don't like to see, especially since the interest rates are very high at the moment. The following table shows how much debt BAT must pay when. The highest value is 4.3 billion within 1 year, which is much lower than the free cash flow. This means BAT will be able to pay back its debt and pay dividend at the same time the next 5 years. So the dividend is safe and not endangered by the debt. Now let's jump to valuations. BAT has a 1.96 price to sales ratio, a 5.68 price to free cash flow ratio, and a 1.03 price to book ratio. Pause the video and check how the current ratios compare to previous years. Now let's do a discounted cash flow analysis to determine the fair price and intrinsic value of the stock. This is how my model works. I calculate the worst case scenario to determine the downsides, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple or the PE multiple at which the stock will be sold in 10 years. The fourth column represents the discount rate or the rate of return the stock will grow over the years. Considering a 3% growth the first 5 years, a 0% the 5 years afterwards, a terminal multiple of 6 and 15% discount rate, the intrinsic value of the stock is $23.89. BAT is trading at $29 currently, so the stock is overvalued. And yes, I know I made conservative assumptions. Now let's discuss the dividend paid by the company. On this chart, the blue bar is the free cash flow, the orange one is the dividend paid every year to investors, the yellow line is the payout ratio. As you can see, the payout ratio was very high in 2014 till 2017. Afterwards, the company focused on paying its debt and the payout ratio decreased to around 50%. This is good because this way the company will be able to pay back its huge debt. The last dividend per share in 2023 was $2.92. Currently, the stock price is $29.8. This results in a 9.8% dividend yield, which is relatively high. Finally, let's do the 3M analysis. 1M for moat, 1M for management, and 1M for margin of safety. BAT has a strong moat. Its products are addictive, forcing the clients to stick with the cigarettes brands they are smoking. Management took huge debt that the company have to finance. It is okay to take debt if it leads to growth. However, the revenue of the company are not growing. The company is trading above intrinsic value using the conservative assumptions that we took. The balance sheet is loaded with debt. In conclusion, should you buy this company? Let's first check what analyst says before I give my opinion. Most analysts rate the company as buy or hold. What I think is that also the dividend yield is attractive. The smoking industry is declining and will keep declining, forcing the company to lose revenue. The company is loaded with debt. I personally do not invest in companies that cannot pay their debt within 2 years. And the management is distributing dividend instead of paying the debt they have. Furthermore, the company is trading above intrinsic value. I can understand if dividend investors will find the opportunity attractive. However, I have no interest in investing in BAT. Let me know in the comment section below what you think of this company and if you will invest in it. If you found value in this video, please give us a like, this helps a lot, and consider subscribing. Thank you very much for watching.